The following is a paid program for Principal Preservation Services, LLC.
Here's what's coming up on Retirement Reality Roadmap with Mike Koyanen.
Typically, different type of accounts you can take more risk on. So when we're talking about your IRAs, the dollars you have to take withdrawals out, why would you want to be super aggressive with those dollars? Be aggressive with the money that you might be leaving behind as an inheritance. You know, the play money, the fun money, or you have that account you just like to do some, day trading with.
Mutual funds can have some pretty high expenses that aren't necessarily very clear to each individual investor. So it's important to understand what fees are associated with those front-end load fees that cost money to get into the funds. ETFs, they don't have those high fees as well. They have a lot lower fees, so they can trade faster as well.
Sometimes those fees are significantly lower.
The main objective of a Roth is to have earnings grow tax-free. That's the main objective. But after that, they are used for tax planning.
You need to do your due diligence. You need to come into the office. You need to get that Social Security plan. You need to look at the tax report that we will run for you and show you where things are at. What is the best date for you to file for your Social Security benefit?
And now, the host of Retirement Reality Roadmap.
Hi, and welcome to this week's show.
We have 30 minutes of great information designed just for you.
Don't go anywhere. The show starts right now.
Hi, and welcome to this week's Ask the Advisor. Were you the Twin Cities area? Email your questions into us, and we answer them right here on the show. Mike and Joe, you ready?
We're ready.
All right, my first one, Mike, is for you, and it's from Beatrice in Minnetonka. And she writes, I heard an advisor on the radio talk about stress testing my portfolio. What does that mean?
Well, stress testing isn't supposed to get you stressed out. And what it is we run software on all of our clients. We input all the data. What we want to show you is if we have a bad maybe decade, like 2000 to 2009, where we had the tech bubble, 2001 and 2, and then the market recovered, and then we had the real estate bubble again. How would that if that was you, if we went through that again, would you be able to stay retired? Would you run out of assets or not run out of assets? And that's a big stress test right there. So we want to make sure that you're going to come out of it with flying colors, essentially.
How often do you stress test a portfolio, show the result, and then this couple or individual have to say, my goodness, I had no idea we were taking that much risk with our money? Because most people would say when you ask them, Mike, I would imagine, are you comfortable losing any money? Well, no, of course not. I'm not comfortable. Right. Well, in this scenario, 30% or 40% would be lost, and you'd have to gain that back.
Yeah, 70, 80% of the time, people are just shocked going through that stress test to see what they could potentially lose. And that could make a difference sometimes of having enough money till you're 100 to running out of money at age 85, going through a decade like that. It's a scary situation. And they said, I never thought that having so much risk was going to affect my money so diversely there.
Yeah, I kind of equate this to, as we get older, we see certain doctors, I'll say cardiologists, and they perform all those tests, right? And I believe one is actually called a stress test.
Yeah.
But then you get some results that show you, okay, I now need to change lifestyle possibly, or maybe everything's fine. But if you're not doing this, then you're not giving yourself an optimal chance. Hey, you've worked so hard to save all of this money.
Right.
Let's get it checked out. And how difficult is this, and how expensive is it to have a stress test done at your firm?
It's not difficult. If you have a few hours of your time that we can gather information, and we don't charge a thing. So the key is get it done. What's the risk to you? Besides the risk of running out of money if you do things wrong. So that's the key.
Joe, my next question is for you, and it's from Ann from Cottage Grove, and she writes, is there a formula we can use to calculate if converting to a Roth is right for us?
Thank you, Ann, for writing in. Thank you. There really is not a formula. What we are doing on an annual basis is looking forward. We're looking forward, planning your taxes out. As far as Roths go, the main objective of a Roth is to have earnings grow tax-free. That's the main objective. But after that, they are used for tax planning. So we're looking forward on your taxes, especially when we get to your required minimum distribution age, keeping you below the IRMA thresholds, which can be a big issue for some higher, income individuals, where we don't want to see them have to pay more for their Medicare costs just because they didn't plan ahead and do some Roth conversions early. Recently now, with the change to how inherited IRAs work, another reason individuals would do Roth conversions would be for estate planning. It could be way more advantageous for them to do Roth conversions right now, pay the tax at a lower tax bracket, especially if their children are the beneficiaries and they know they're in high tax brackets already. It's just going to compound their issue when the time comes and they have to redeem all of this tax-deferred money they're receiving and put it on top of their already high taxes at some point.
Thanks, Joe. Mike, my last question is for you, and it's from Jewel, and she lives in Eagan. Mike, I feel like our investments are all over the place. My husband and I are very conservative. Where can we put our money today to keep it totally safe besides the bank? Also, we'd like to have it grow a little too.
I hope so. Thanks for writing in, Jewel. That's first of all, a scary place if you feel that your investments are here and there and no control over them. Definitely come in. We want to assess where you're at. Look where all these accounts are at. Do a risk assessment for you to find out where should you be investing. Now, even if it came up maybe as a moderate risk or moderately conservative, you can always go more conservative. And we have those conservative investments out there with good rate returns that are beating bank rates. So we have index annuities, we have, say, fixed annuities, we have structured notes. We have a lot of different options that we have no risk at all. And I think it would definitely warrant a meeting in our office so we can show you what you have and where you can go to and is that a better fit or not.
Mike, Joe, thanks so much. If you want more information on the topics we spoke about today, hey, give us a call in the office or go to our website. And don't go anywhere. We'll be right back.
You're watching Retirement Reality Roadmap with Mike Koyanen.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm Mike Koyanen of Principal Preservation Services, and we've been helping families with their retirement goals and dreams since 2014. We specialize in comprehensive wealth management strategies and retirement planning. Together, let's create a cohesive plan and maximize your assets in retirement. Call today or scan the QR code on the screen to set up your complimentary visit. Principal Preservation Services, where retirement dreams become reality. On this week's Retirement Reality University, we're going to talk about the Social Security Provisional Income Formula, which is called the Benefits Tax Threshold. So this is confusing, and actually, I was at a seminar recently, and the seminar speaker talked about the Provisional Income Formula to CPAs, and 95% of the CPAs in the room never even heard about the Provisional Income Formula. And this is what determines how much of your Social Security benefit will be taxed. So let's look at it over here. If you're a single filer, income earner, when we look at these numbers up here, this $25,000 and $34,000. So how they tax Social Security determine how much of your Social Security will be taxed. This old formula that hasn't changed. And either have the numbers. And I'll explain that in a second. They take half of your Social Security, plus any pensions or IRA withdrawals, any other income that you might have. If it's $25,000 or below $25,000, you won't actually pay any taxes on your Social Security. Kind of impossible to be in that number today. When you look at this number in parentheses right here, $92,775, that's what it should be today. That's what it should be if they did cost of living adjustments on that number that they enacted here in 1983. And it started in 1984. Isn't that sad? This is what the numbers should be. So today, more people are paying taxes on their Social Security today than they ever have. And they need to change this rule. When we get our tax returns, we look at the thresholds every year, the marginal tax brackets. They change every year. They haven't changed here. Now, when you look at, if you're over that $25,000, half of your Social Security above that number will be taxed as regular income. It's not a 50% tax. It just means half of it will be taxed as regular income. Now we get to that number, if that provisional income formula lands above $34,000 for a single, Now 85%, now that's the max you can pay. 85% of your benefit could be taxed as regular income. When we look at the married filing jointly, we see these numbers of $32,000 and $44,000. Look at this number, folks, $118,752. That's what it should be today, based off what the values have changed with inflation over the years. So I was on a plane here a few years ago, and Dean Phillips, one of the congressmen there, was on the plane next to me, running for office a few years ago. He asked me, Mike, what I was doing in this field. I told him, and he said, what is the change that we should be making? And I told him, this needs to be adjusted. This is a travesty to seniors. More people are paying money in taxes on Social Security than they ever have. He actually listened to me. I don't know, he's not in office anymore, but he took the time to listen, and I really hope, folks, that this is going to be changed. This should be part of the changes with Social Security to make it more fair, because we're paying more money in taxes. Now, this is on the federal level, folks, the federal level. The state level, they take these numbers and they put it into the state. Now, there are 9 states that still tax Social Security, Minnesota being one of them. When you reach a certain threshold, to pass the threshold, they will still tax. Wisconsin, they do not tax on the state level in the state of Wisconsin. So you need to understand this, because when we look at the provisional income formula, it's part of your income. And when we're looking at taxes, we're looking at this number when it falls into the tax brackets, the marginal tax rates, and your gross income, your adjusted gross income. We really want to know what this number is. What we're finding, folks, if you file for Social Security early, we're finding more people are paying more taxes on Social Security than they should have. Because why? You're having to take money from these other accounts, these IRAs, these 401ks, at 100% taxable, where Social Security is partially taxed, which, in my opinion, it shouldn't be taxed, but it is partially taxed. So if you file Social Security early, we're finding people are paying more money in taxes than they should be. Now, I'm not telling everybody to wait to file for Social Security. It's not the plan for everybody, but what we are saying is you need to do your due diligence. You need to come into the office. You need to get that Social Security plan. You need to look at the tax report that we will run for you and show you where things are at. What is the best date for you to file for your Social Security benefit? So call the number if you want that for your report. Go to the website if you want that for your report. We're going to help you out. We're going to help you understand your Social Security benefit, and you're going to be the expert on the block for all your family members as well. Stick around, there's more to come.
You're watching Retirement Reality Roadmap with Mike Koyanen.
From my experience, many retirees keep too much of their assets in the stock market after they retire. A well-diversified retirement portfolio should have assets in each of the 3 different retirement stages. The youth stage, putting money into savings. The adult stage, putting money into growth investments. And when you reach that mature stage, you should transition from growing and risking to more protection and guarantees. If you aren't sure about your risk, call now or scan the QR code to get your custom retirement reality roadmap. There's no obligation and no cost if you have at least $250,000 saved for retirement. Here's what you'll get: a free report to sort through your current investment risks and fees, a tailored strategy to help protect your assets, a tax analysis to potentially reduce your tax liability, a custom income plan, and even a budget analysis if that's needed. Let us help you. Call now or scan the QR code on the screen to schedule your complimentary consultation. Principal Preservation Services, where retirement dreams become reality.
Hi, and welcome to this week's Retirement True or False. Gentlemen, I got some great questions. Mike, I might even stump you this week. I don't know. But my first question is for you, sir, and it is, if you have already retired, then it's too late to get a second opinion about your portfolio. True or false?
That's false. We're seeing this about 50% of the time. People come into our office already retired and looking to finally put a plan in place. I mean, it's a little backwards, but at least I commend them coming in and working on it, because they're scared. They're scared. They've been working with that same advisor for 15 years, 20 years, and they found out they retired and nothing has changed. And what has changed is you don't get to contribute to your 401k or IRAs anymore because you have no more income. You don't get employer matching funds anymore. So you need to have a different plan of attack. You know, I look at it like football. You know, our football season just ended here. When we look at the first half is your working years, you go to halftime, you have to make adjustments. And that plan, that has to look different in that second half than the first half. If it looks the same, you don't have a plan in place.
You know, it reminds me, I still have in my glove box an atlas, a map, right? Just in case. I have it in there. And I remember my kids telling me, like, what do you do with this? What do I do with this? This is how I used to get from this point to this point. Then MapQuest came along, right? You'd punch in, here's where I am, here's where I want to go. And a plan actually took place to get to that. Now we have GPS. I just say where I'm going to go and it does it. But I just wonder with some people that you sit down with, that they say they don't have a plan. Well, how are you planning to get to your destination, your goal, your dream in retirement with you, your spouse, your family, your children, your grandchildren? What is your plan to get to your retirement dreams and goals? And if you're telling me it's like 13 to 15%, that's 85% out there that can't pull out of a draw a written plan as to where they're going for their retirement goals and dreams. And I put it that way too, that this is a time to dream, right?
Yeah.
Like I've worked so hard all my life. In fact, the average American will work 90,000 hours, 42 years to get that nest egg to do now what they want to do. Come see an advisor, get that plan if you don't have one.
I agree.
Dave, my next question is for you, and it is, ETFs and mutual funds are the same product with different names. True or false?
That is false. So although they share some similarities, mutual funds and ETFs both give you exposure to lots of different companies. There's some pretty key differences as well. Mutual funds can have some pretty high expenses that aren't necessarily very clear to each individual investor. So it's important to understand what fees are associated with those front-end load fees that cost money to get into the funds. ETFs, they don't have those high fees as well. They have a lot lower fees, so they can trade faster as well.
You know, sometimes those fees are significantly lower, not like a little bit lower. And I always love it with the fee question that pops up from time to time. Like, when I open my statement, all those fees are on there, right? I can see it. Or do I have to wait for that big book to come in the mail?
Usually those fees are hidden in that big book.
And
so
some of it's on page 9 and some of it's on page 14, caveat emptor. Some of them are page 72. I might actually keep a copy of one of those on my bedside table. So when I have insomnia, I get to about page 4, right?
Yeah, exactly.
So you have to be very careful. And though they do a similar thing, you know, in your professional opinion, you know, at principal preservation, are we more about mutual funds? Are we more moving to ETFs? Do we find which is potentially better for most clients?
We prefer the ETF method. Just like I said, they can trade a lot faster, so you're able to be a lot more agile in changing markets. The lower fee structure, like you mentioned, sometimes front-end load fees on mutual funds can be as high as 5%, where the trading expense for a mutual fund might be 1/4%.
Explain what a front-end fund is. A front-end, that you have to pay that up front before it actually goes into the market, right?
Yes, exactly, and that's exactly what it is. It's a fee that you pay before that investment gets purchased.
So for example, I'm investing $100,000 with you. What happens to that 100?
So let's just say that there's a 5% front-end load fee there. Well, then you're paying $5,000.
So only $95,000 gets invested?
Correct,
right?
Yeah, so a lot of times those are the fees that are hidden from you, so people are thinking that all their money is going towards their investments, towards their retirement, but a lot of times a big chunk of that money is going to those companies that they're investing with.
Mike, my last question is for you. I have about 1 minute.
Okay.
And it is, taxes will not go up in the future, period. True or false?
I wish it was wrong, but it is false. We're under the Tax Cuts and Jobs Act that is set to expire at the end of this year, 2025. So we're under the lowest tax rates we've seen in history. So with our national debt is exceeded $35 trillion. Our interest on our debt is over $1 trillion. We have no place to go but up with taxes. That's the only way we can do it. So unfortunately, we have to plan accordingly for that. So this is a great year to be planning for conversions, if that's a good fit. It's not a fit for everybody, but if this is a need for your plan, maybe just to keep your healthcare costs low, your income low enough so healthcare won't be too expensive. So there's a lot of pieces of the puzzle that we want to make sure that are we being proactive? Are we looking at taxes today for the future, for tomorrow, to keep your income in the right brackets?
So is it possible that Congress could approve keeping taxes at the same level? They have to get everybody together for that, right? They'd have to work together to make that happen. But do you see that as a possibility, or that taxes will in fact potentially go up?
I think there's a good possibility under the current administration and where Senate in Congress is at, that it could be extended. So that's our hope anyways. That's our hope, is to keep these brackets where they are for a while. But reality is they have nowhere to go but up. If our national debt keeps increasing, our spending is exceeding our revenue coming into the country. There's a problem. We have to fix it.
Otherwise, they sunset when?
December 31st, 2025.
Okay, so let's just talk about that for a second, because in theory then taxes are on sale for one more year.
Exactly.
Would it be wise for some people to take advantage of that, and how could they?
Yeah, so when you come into our office, we're going to show you, help you understand. A lot of people are confused with the tax brackets. So we're going to show you the marginal tax rates, your effective tax rates, and we'll look at future tax rates. So maybe when you're in those required minimum distribution years, RMD years from 73 on or 75 on, to show you what will your income be. And some people will be really maybe a lot higher than it is today. Because maybe they're not needing income out of their IRAs today in retirement, but they're going to be forced to do that. So we can be proactive and start looking at some conversions. We can also be proactive when it comes to maybe they're charitable. So once you're 70 and a half or older, we can start giving money to charities directly from your IRAs, so it's not a taxable event for you. And so it's called a QCD. So we can look at things like that. We're just going to give you any kind of ways to win that people haven't been looking at.
Mike, Dave, thank you so much. If you liked what you heard today and you want to hear more about it, it's so simple. Just give us a call in the office or go to our website. And don't go anywhere. We'll be right back.
You're watching Retirement Reality Roadmap with Mike Koyanen.
Welcome back to Retirement Reality Radio with Mike Koyanen. You know, I love this next topic, Mike. I love it because we're going to explain this to people, because I think that the consumers out there, they don't understand this term, and it is risk tolerance.
Right.
Okay, they've got all their accounts and this and that, but what does risk tolerance actually mean? And it's from another show that we did. You know, you asked point blank to new folks in there, how much are you willing to lose? And their answer to you was, we don't want to lose a penny.
Right.
And then you said, well, do you understand that all of your accounts together have a very high risk tolerance associated? It's very risky, in other words. And then why are you in these accounts if you don't want to lose any money? Right? So it's important to know what your risk tolerance is, and that the vehicles that are going to get you to your retirement goals and dreams, meaning your accounts, of course, and the products that are in there, are in fact matching your risk tolerance. So let's start with, what are you comfortable with, right? That's what you got to ask someone. What are you comfortable losing?
Right. And it's just not that statement in itself. We will do a full risk assessment. It's a 10-question survey, so to speak, to give you a score at the end from 1 to 100, where 100 is the highest risk, 1's the lowest risk. And what we're finding is when we do that risk assessment and then we go to our software and we show them how they're investing today, and that comes up with that score, there's a dichotomy here. We have some high risk and we say maybe you're moderately conservative, things aren't matching up.
Yeah, and I want to expand on that, because if you say, I'm just going to make up arbitrary number. I have $1 million, I'm willing to lose 5%, but never more than that in any given year. And then you run it through and it says, well, you could lose up to 38% in normal scenarios. This could potentially happen. Are you prepared to take a $380,000 loss, and then hopefully it comes back in a reasonable amount of time? How many said, yes, I'm good with that. I'm totally fine with, I'm a conservative person, but, or do you hear, you've got to be kidding me, Mike. There's no way that I'm set up for that to happen.
If you come up with a conservative score on that assessment, I've yet to find anybody say, I'm okay with that.
Yeah.
What we are finding is there's a rare occasion somebody takes that assessment and they're an aggressive investor in their 60s. That's rare. And they're like, yeah, I'm okay with being in the market. And I've had people say it's risky not to take risk, and that's fine. We can't be a fit for everybody.
Would it be fair to say that that person isn't using 100% of their money in the market, though? Like, they're okay with maybe taking 30% and getting like crazy aggressive with it, but they're not going to necessarily have 100% of their nest egg in a massively aggressive position in their 60s.
Right. Typically that's true. And typically different type of accounts you can take more risk on. So when we're talking about your IRAs, the dollars you have to take withdrawals out, why would you want to be super aggressive with those dollars? be aggressive with the money that you might be leaving behind as an inheritance. The play money, the fun money, or you have that account you just like to do some day trading with. That's okay to have some risk, but don't do it with your IRAs. Don't do it with the Roth. Don't leave it with that inheritance money, like the Roth money, the tax-free money.
And I think that, this is why this topic is so important to me, because I talk about, I represent John Q. Public when I do this, right? And I know there's a lot of people out there, Mike, that the product they have says conservative fund.
Right.
All right, or it has some implication that this is safe to it somehow, when in fact they're very much tied to a volatile market, and there's nothing conservative about that.
Right.
So this is so important to get that second set of eyes to view what you have. Man, these are the monies you're going to use for retirement. Is it safe? Are you well planned? I always like to say the pathway to your retirement goals and dreams. Are you set up appropriately for that?
Right. And when we do that full assessment with our software, we do a little stress test with that as well. If we have a 2008 again, what would that look like? Or the whole real estate bubble, or even a phenomenal year like 2013 where the market was up 30+%. We want to show you the good and the bad. We like the good, but the bad is what we can't tolerate, right? So the key is we want to have that assessment. We have the truth is coming out, right? So we can't just hide behind the statements anymore. And we've seen when people invested in these 401k plans, a certain investment comes up more moderate, but it's listed as moderately conservative on their statements, and it doesn't line up. So we can show them if it's accurate or not.
Yeah, because listen, there's a time and a place for risk, right? Your 20s and your 30s, maybe even the early part of your 40s, right? Before you're like, okay, I'm getting serious about the whole retirement piece. But in your 50s and 60s, your portfolio shouldn't look like a 20 and 30-year-old with super high risk and a lot of time and forever in front of you to make more money. Because when you stop working, the checks are stopping.
Right.
You got to take care of that, right?
Exactly. And we had to look at where we are, at our age today. I know I mentioned this before in a previous episode. We look good, we feel good. But when we look at our parents when they were this age, we thought they were old, but we don't call ourselves old, right? We have to adjust based off where we realistically are in life.
Yeah, and people are going to retire longer. All the more reason to get this worked out. Mike, so many great topics today, and it's so important for people to come in. So I'm going to tell you right now, pick up that phone. Let's start a conversation. Come on and see Mike and the team. You're listening to Retirement Reality Radio with Mike Koyanen.
You're watching Retirement Reality Roadmap with Mike Koyanen.
Thank you for watching this week's show.
And if you want information regarding anything we spoke about here today, hey, give us a call in the office or go to our website.
Principal Preservation Services, where retirement dreams become a reality.
The preceding program is sponsored by Principal Preservation Services, LLC.